In episode 121 of the All In podcast, Jason, Shamath, Sachs and Freeberg discuss the Fed hike, CRE Debt Bubble, TikTok's endgame, and more. They discuss the recent Fed hike by 25 basis points, and how people are speculating that the Fed doesn't know what they're doing. Sachs believes that they were late in reacting to inflation and may be making the opposite decision now by raising the rates. He argues that the Fed is ignoring the potential stress building up in the banking system from the recent banking failures. They also discuss the CRE debt bubble, and how it could potentially lead to a financial crisis like the 2008 recession. The speakers on the All In podcast discuss the correlation between the stress on the banking system and the hostility towards cryptocurrency. In particular, Gensler's stance at the SEC. Some suggest that the government is purposely making it harder for people to find an off-ramp for their investments as they deflate the dollar. However, others feel that this is merely coincidental, and that the SEC is pivoting towards being more active, in part due to the losses suffered by consumers in the crypto market. There is also discussion of a rumored executive order from the 1930s, where FDR confiscated private gold bullion, and some suggest that history may repeat itself with cryptocurrency. One speaker notes that, while there are valid concerns about the fragility of the banking system, connecting these concerns to Bitcoin sounds like a crazy person only talking their book. They note that the total number of non-zero Bitcoin wallet addresses is insignificant when compared to the world's population, and that most people in Bitcoin are not trying to hedge their fiat currency exposure, but instead just day trading. However, they do believe that there is a place for Bitcoin in one's portfolio. They urge listeners to focus on the facts on the ground, such as the looming debt ceiling problem and the commercial real estate crisis. The discussion also revolves around different perspectives on how to handle banking crises and the moral hazard that comes with it. While the old-fashioned view suggests that depositors should lose their money in banking crises, the more modern regulatory view suggests that depositors should not have to think about the bank's balance sheet and should be protected by the government. The leading proponent of the modern regulatory view is Bill Ackman, who argues that if deposits at small banks are not protected, all the money will flow to the top four banks. Therefore, there is a debate on how to handle depositor protection without risking moral hazard. While Ackman advocates for backing up deposits, some argue that it would lead to a false sense of safety and encourage risky behaviors. Furthermore, people should be encouraged to shop for the right bank that aligns with their values, so banks can balance risk and reward. The podcast then discusses the idea of backstopping the deposits of American banks. If banks were required to guarantee 100% of their deposits, it would come at the expense of the equity holders of the banks. However, there are examples of the free market creating new products and services to cover this gap, such as load balancing across multiple accounts and various crypto solutions. The function of a bank is to loan money to buyers, and they earn a return on those investments. The value of the assets held by banks may decline, but it doesn't mean there is no asset value. If the buffer between the asset value and deposits gets exceeded, the bank has negative equity, and depositors may not receive 100% of their deposits back. However, an orderly dissolution of the bank's assets and selling them into the market can generate cash to pay the depositors back. The reason for the Fed vertical spike number is that assets and depositors are moving so quickly from one bank to another that banks have had to borrow from the Fed and sell bonds to generate the cash to pay depositors back. This has caused problems like musical chairs, and if people stop moving deposits around and banks backstop deposits, this problem could be resolved. Then they discuss the current state of the banking system in relation to startups and the FDIC. Shamath suggests raising the FDIC to $2.5 million or allowing a higher class of FDIC that goes up to $10 million in exchange for the bank not putting that money in risky assets. He explains the role of an insurance underwriter in determining the probabilities and severity of potential loss in the banking system. However, the problem with insurance models is that they do not account for extreme tail events that have never happened, leading to underpriced insurance that is only realized when a crisis occurs. To address this, Sachs suggests insuring everyone, which would make insurance cheaper because it would minimize the risk of a bank run. The hosts also discuss the drawbacks of placing the depositor in charge of disciplining the banks and highlight the need for regulation in the banking industry. They point out that startups are currently using multiple bank accounts to work around the FDIC limit, suggesting that the government needs to raise the limit or offer an alternative solution to avoid creating extra work for everyone. The conversation switches to the issue of banking and the disconnect between what consumers think they are getting when they open a bank account versus what the banks actually do with their money. They discuss how consumers think they are getting a safe place to store their money, while banks see it as an unsecured loan that they can invest for their benefit. The banking system creates incentives that drive risk-taking behavior, particularly in smaller banks like Silicon Valley Bank. They also note that banks have become better at risk management in recent years, leading to the emergence of private credit markets. the Federal Reserve is going to release an investigation report into Signature Bank and SVB, which will shed light on their risk-taking behavior. They believe that if the report is honest and transparent, it will be difficult to not legislate changes based on it. They suggest a simple solution, which is for banks to protect 100% of deposits and raise money from investors to carry out extracurricular activities in a fair and transparent manner, similar to other risk-taking organizations. There is a mismatch between what depositors expect and what risk managers are doing, and this needs to be corrected. They also note that while not all bank managers are gambling with depositors' money, the incentives created by the system to create a weird incentive for them to do so. Finally, there is a discussion about the limited partnership agreement and equity value in banks, and the need for clear communication between banks and depositors regarding expectations and risk-taking behavior. They also discuss several topics including the raising of the bar on eligibility from 50 billion of assets to 200, and how it made no sense to categorize banks as systemically important. They also talked about the CEO of TikTok, Shou Chu's appearance in front of Congress, and how it did not go well for the company. They debate whether TikTok should be divested or shut down, with some believing that it should be given the chance to divest to an American-owned company. They also discussed the bipartisan nature of the outrage directed at TikTok, with some expressing a desire for more outrage directed at the deep state spying on Americans. Additionally, they talk about the potential national security implications of TikTok and the Chinese government's control over social behavior. Some of them believe that TikTok will likely have to spin off and divest to US investors, while others suggest that the Chinese refusal to sell could indicate bigger problems in China than just TikTok. The discussed topic in the transcript is the potential ban of TikTok in the US due to concerns of data privacy and alleged ties to the Chinese government. They express skepticism towards the possibility of the divestiture of TikTok, citing concerns over how the separation of the code base and absence of malware could be proven to satisfy the government's demands. Instead, they believe that the government may opt to shut down the app entirely. One point of concern is TikTok's relationship with China's Communist Party and the potential for data privacy violations or backdoors. Another issue is the influence of the Chinese government's golden vote, which gives them control over the direction of businesses such as ByteDance, TikTok's parent company. The guests speculate on the potential impact of a ban on US-China relations but suggest that tensions are already high between the two countries. Additionally, Shamath provides an update on a successful launch by his company, Relativity, which aims to bring down the cost of space flight using 3D printing technology. They go on to talk about the democratization of access to space and its impact on humanity, the importance of low-cost energy in the space industry, and the need for space startups to find profitable business models outside of government contracts. The guests discuss the technical milestones achieved in rocket building, including the production of a pure methyl ox engine, which simplifies the engineering problem and ground operations. They note that the cost of electricity has a tight coupling with the vibrancy of the space market, and low-cost energy could lead to cheaper fuel production and processing for rockets. However, the key challenge for private space companies is how to move beyond government services and generate valuable businesses that attract private market attention. Potential areas of exploration include space tourism, travel, mining, colonies, and real estate, although the ultimate endgame for space activity remains uncertain. The host then moved to disagreeing on the Fed's decision to raise rates by 25 basis points. Jason suggests waiting another month before raising rates, while Shamath disagrees and thinks they should have raised rates by 50 bips to gain clarity on what is fundamentally broken and to give the Fed the ability to use their balance sheet and liquidity in the future to solve the problem. Friedberg, on the other hand, focuses on the yield on the 10-year Treasury and how it impacts the value of assets held at banks. The risk of impacting the value of a chunk of that portfolio down 25 is potentially dangerous to certain banks that are overweight in 10-year bonds. The commercial real estate debt bubble is another concern mentioned, where unrealized losses on long-dated bonds and commercial real estate loans have yet to surface as a problem. The group discusses how the Fed has the tools to either let inflation run amok or have massive illiquidity in the financial system, and the worst thing the Fed could do is take the middle path, which is what they did. In this portion of the All In podcast, the speakers discuss the impact of recent market events on various types of debt, including mortgages, treasuries, corporate bonds, and real estate bonds. The main question at hand is whether the short-term rate actions are driving down long- and medium-term rates in a way that improves the balance sheets of institutions that own a lot of this debt, particularly banks and funds. The speakers suggest that recent market trends indicate that things are improving and becoming more stable. However, the focus then shifts back to the topic of commercial real estate debt and the potential for a bubble. Sachs, who is an owner of some commercial real estate, notes that there is a credit crunch happening in this space, making it difficult to refinance loans or put long-term debt on buildings. Banks are getting more paranoid and defensive, seeing deposits flee from their banks. Additionally, small banks hold around $2.3 trillion in commercial and real estate debt, and almost 80% of commercial mortgages are held by banks, leading to concerns about the large number of unrealized losses in commercial real estate loan portfolios. This makes it difficult to know how impaired the loan portfolio is until there are defaults and repricings of assets. Regarding commercial real estate, the question is whether it should be bailed out. Many CRE loans have been extended without sufficient safety net mechanisms, leading to a possible debt bubble that might burst. The real estate industry is undergoing a major crisis due to the pandemic's impact. Most leases of 5 to 10 years have come to an end, and many tenants do not need the space anymore. This means that the landlords are now trying to rent out vacant spaces or sublease them. The leaseholders still have to pay rent according to the existing contract, but some are now negotiating a much lower rent. Consequently, the real estate owners cannot make their debt service covenant ratios, and the income from the building is now substantially less. Many bank loans for real estate are rolling over at the same time, and the owner has to refinance it. However, due to the credit crunch, they may not be able to refinance the loan at a lower cost, making it challenging to keep up with payments. If the owner defaults on the debt, the bank ends up owning the building, leading to a whole bunch of downtown San Francisco owned by banks. The banks then have to sell the buildings, and since there is no liquidity or buyers, they have to auction them off at rock-bottom prices. Due to the pandemic, the commercial real estate market is crippled, with many empty office towers, making it difficult to sell at current prices. To support the asset prices, the Fed must backstop banks, printing money and creating programs. However, this may lead to a dangerous debt spiral that could have catastrophic effects on the economy worldwide. The discussion in the All In podcast also centers around the impact of leveraging and debt on macroeconomic growth. The guests argue that leveraging can magnify asset value, but it can also cause significant stress on the system when there is a natural recessionary effect. The COVID pandemic has caused natural asset price declines, and the guests agree that this situation demands a stimulus package that should include support for real estate and banks. This package is crucial because the majority of the country's population has their assets or equity value in their homes, and if there is a significant write-down in the value of the asset class, it can lead to a crisis. The guests believe that inflationary behavior is necessary to support the economy, and money printing is essential for countries to get out of this hole. The guests then discuss the effectiveness of modern monetary theory, stating that printing money can be an effective strategy for a well-functioning society where there are no winners and losers, and everyone can win. However, one guest believes that winners and losers are vital to making a society function well. The guests also touch on the topic of the US dollar hegemony and its dependency on other countries. The Fed provides swap lines and moves the liquidity window to support other central banks during times of stress. Finally, the guests briefly mention Balaji's Bitcoin bet, where he predicts hyperinflation and the end of US supremacy. However, the guests believe that it is more practical to look at dollar flows, which go up during moments of stress in a distributed manner across the monetary plumbing of the world. Balaji made a bet that Bitcoin would reach $1 million in the next 90 days due to hyperinflation in the US. While the rest of the participants find this prediction unlikely, they acknowledge Balaji's track record of being selective in his predictions. Additionally, Balaji makes several other predictions, including that regional banks are insolvent, and that the US will print more money and cut rates, leading to hyperinflation that will devalue the dollar. The participants also discuss CRE and government debt as the next two phases of a financial crisis. While they agree with some points, they also disagree with some of Balaji's more extreme predictions, such as relocating to Wyoming, Texas, or Singapore, and the need to leave the US banking system entirely. They touch on the economic updates and the potential impact of Bitcoin. They anticipate a highly deflationary crisis in the commercial real estate market, leading to a reduction in liquidity, while inflation could occur if the government inflates and monetizes their debt. However, it is challenging to predict when or how these events will unfold. While Bitcoin offers an independent storage system outside of government control, it may not be accessible enough in an inflationary crisis. Some companies that generate sales internationally may be a better place to put money. The guests also emphasize the risk posed by the upcoming debt ceiling vote in June, which could result in the US defaulting on its debt. They suggested that both parties agree on wasteful spending programs to avoid defaulting. The podcast changes topics to the debt ceiling, inflation, and the potential decline of the US empire. One guest, Friedberg, agrees with Ray Dalio's view that the US is on a path toward decline due to its spending behavior and the way markets are reacting. However, he does not believe there will be hyperinflation like in the Weimar Republic, as the US dollar is the reserve currency, and it would require collective agreement to get off the dollar. Instead, he believes there will be inflationary effects and massive asset value shocks. They also discussed the recent crackdown on crypto, which includes the SEC suing crypto infrastructure company Paxos and settling with crypto exchange Kraken. There is speculation that the US government wants to break the back of crypto while dealing with these issues with the US dollar. An article by Nick Carter on Mike Solana's Substack suggests that Operation Choke Point is a coordinated effort to ban crypto, and the steps taken by the Biden administration to go after crypto seem to support this theory. Check out the full podcast by clicking the link in the description below. Make sure to like, comment, and subscribe for more content like this. Thank you for listening to this podcast summary episode of the Pod Slice.